Can you believe it? It is like witnessing a bull and a hedgehog dancing together in perfect sync, exclaimed a stunned trader on the floor of the iconic New York Stock Exchange, capturing the absolute bewilderment that has swept through financial circles worldwide. On one hand, the Standard & Poor's 500 has roared toward unprecedented heights, riding a wave of robust tech earnings and surprising resilience across major economic sectors. On the other hand, gold, that perennial symbol of caution underpinned by centuries of trust, seems equally unstoppable, ascending toward stratospheric price levels. But how in the world did we end up in this bizarre market moment where the classic safe haven and the prime equity benchmark march side by side, almost as if fueled by the same unstoppable rocket? Today, we will uncover exactly why these two seemingly opposite forces have found themselves in a rare alliance, examine the delicate balance that might sustain or disrupt their parallel ascent, and highlight the deeper implications for global finance. In mid-2025, global finance found itself at a crossroads that nobody seemed to anticipate. On the surface, the Standard & Poor's 500 soared to nearly 6,020 points, placing it just a few steps behind an all-time record perched slightly above 6,144 points. Meanwhile, gold sparkled with dazzling brilliance, climbing by almost 27% since the start of the year. Investors accustomed to treating gold as a refuge only in times of looming crisis now found themselves scratching their heads. Why on earth would traders snatch up bars of this precious metal when they are at the same time brimming with confidence in corporate earnings, tech expansions, and a strong labor market? Just what is fueling this sudden love affair between bullish sentiment on growth and the time-tested security blanket of gold? In this deep dive, we will explore how cautious optimism, central bank policies, and a swirl of geopolitical tensions are quietly but powerfully reshaping the investment landscape. First, let us not overlook the impact of unrelenting central bank support. Multiple major central banks, from the Federal Reserve to counterparts in Europe and Asia, have been showcasing a dovish streak for several quarters. While inflationary sparks have not been entirely extinguished, monetary policymakers appear especially cautious about derailing the fragile economic recovery with an aggressive interest rate stance. This balancing act has effectively lubricated both the equity market by ensuring a steady flow of cheap capital for companies eager to expand, and the gold market by keeping bond yields contained and allowing the non-yielding metal to shine. Under these conditions, it is not surprising to see cautious institutions anxious to hedge sudden policy shifts by amassing gold reserves, particularly when the threat of geopolitical flashpoints could send shockwaves through global trade at any moment. Second, we witness a confluence of macro factors that are neither purely bullish nor unrelentingly bearish. Corporate earnings have indeed impressed analysts, but the global supply chain remains vulnerable to disruptions, and trade relations between major powers, though stabilizing, continue to suffer from sporadic uncertainties. Additionally, rumors of looming fiscal imbalances in multiple advanced economies spark a sense of caution. These ambiguities create an environment where buying stocks makes sense for those chasing growth, yet holding gold also appears prudent to guard against any unforeseen reversal. In a sense, investors are now eating their proverbial cake while keeping a well-insulated second plate on standby, just in case the financial buffet is suddenly shut down due to an unexpected crisis. One of the most intriguing aspects of this parallel rally lies in the institutional flows that have poured into gold. Over the past few years, central banks have not only retained their appetite for the precious metal, but have accelerated purchases, amassing nearly 1,000 metric tons on average in each of the last few years. This intensifying demand sets a new price floor, making it less likely for gold to slip back to historical lows. Meanwhile, gold-backed exchange-traded funds, which saw massive liquidation in previous market cycles, are once again in vogue among investors who want both liquidity and a safe haven anchor. With these robust underpinnings, gold has found itself firmly lodged above the psychological threshold of $3,000 per ounce, a level that once seemed like a distant dream but is now taken almost for granted by a market perpetually bracing for the next shock. Yet, do not be fooled into thinking that this surprising dance between equities and gold can last forever without friction. Technical indicators could be flashing warning signals beneath the surface. For the Standard & Poor's 500, certain oscillators such as the Relative Strength Index have ventured into heated territory, hinting at possible exhaustion in the near term. Similarly, gold has soared beyond its 200-day moving average and is navigating what was once a formidable resistance corridor between $3,300 and $3,350 per ounce. Historically, Such strong upward momentum for both risk assets and safe havens cannot be sustained indefinitely. At some stage, markets usually pause or retrace to gauge whether further gains are justified by fundamentals, sentiment, or a fresh wave of external catalysts. Before we dive deeper into volatility scenarios, let us address the elephant in the room: investor psychology. When people pile into stocks aspiring for blockbuster gains, they typically put less focus on traditional hedges. Conversely, when the clouds of uncertainty loom, gold tends to see a surge in demand, while equity valuations fall. So, what is fueling the appetite for both at once? Perhaps it is a new generation of traders, guided by technological insights and historical lessons, who refuse to be blindsided by a single market narrative. Or maybe large institutions feel the pressure to chase stock rallies, while holding on to a protective stash of gold, for fear that one geopolitical shock or sudden inflation spike could catch them off guard. This dual mentality is reminiscent of having two separate insurance policies for the same house, one for fire and one for flood. It might seem excessive, yet it can feel indispensable when headlines hint at multiple kinds of disaster. So, how vulnerable is this unusual alignment? Let us consider a base case scenario. The Standard & Poor's 500 could breach 6,500 points, riding high on continued tech innovation and stronger consumer sentiment, while gold hovers between $3,100 and $3,500 per ounce, buoyed by persistent central bank buying and unresolved global tensions. If, on the other hand, inflation runs hotter than forecasted, or if political flare-ups intensify, gold may leap even further, possibly nearing $3,700 or $4,000 per ounce. This scenario, however, might test equity markets if interest rates are forced higher in response. Now, if you enjoy exploring these what-if market dynamics as much as we do, feel free to leave a like to show your excitement. Your feedback helps us keep unraveling these intricate financial sagas for you. Meanwhile, a hawkish pivot from the Federal Reserve looms like a potential thundercloud. Just imagine if policymakers decide they can no longer tolerate even modest inflation overshoot. Bond yields could surge, luring away capital from risk assets, and the equity market might find itself reeling. In such a case, gold could hold steady or climb higher, especially if fear of volatility prompts a rush to safety. This is where our narrative intensifies. The harmony between gold and stocks might fracture, leaving each to dance to its traditional rhythm. After all, risk-on strategies typically benefit from easy liquidity and a benign rate environment, whereas gold thrives when alarm bells ring over recession risks or currency debasement. The tipping point may hinge on whether the Federal Reserve and other central banks manage to navigate inflation without choking off the growth that has propelled stocks to these lofty levels. But let us not downplay the delicate interplay of global developments like trade relations, sudden supply chain hiccups, and even the occasional viral outbreak that knocks industries off course. In our hyper-connected world, any one of these elements could become the butterfly flapping its wings and triggering a cross-asset tempest. Investors closely monitor data from major exporters and watch how governments respond to simmering geopolitical disputes. For instance, if tensions between continents flare, putting tariffs or sanctions back on the table, equity enthusiasm could be curbed, while gold's safe haven allure intensifies. On the flip side, a grand diplomatic gesture or resolution could fuel further risk-taking, sustaining the equities boom while taming some of gold's momentum. If you find yourself enthralled by these twists and turns, consider subscribing so you will never miss the next pulse of market drama. In many ways, the current parallel ascent of gold and the Standard & Poor's 500 serves as a living case study for how modern market participants balance optimism and apprehension. Whereas in decades past, a single dominant narrative often seized the reins, be it tech mania or oil shocks or the flight to gold, today's environment is more fragmented. The democratization of financial information, coupled with renewed caution after repeated boom and bust cycles, has led participants to adopt complex strategies aimed at scoring gains while staving off cataclysmic losses. The psychology of just in case now permeates both professional and retail investor bases, driving volume in seemingly contradictory directions at once. Let us put ourselves in the mind of a typical fund manager. She sees robust consumer demand, improved corporate earnings, and consistent signals from policymakers that interest rates will remain moderate unless inflation soars well beyond comfortable thresholds. So, it makes sense to overweight equities, especially in sectors like software, semiconductors, and consumer electronics that are still posting enviable growth rates. Yet our manager may also read the persistent headlines about global power shifts, commodity price gyrations, and the cyclical possibility of a recession. Hence, she decides to keep a hefty allocation in gold, or at least some gold-linked instruments. The quest is to capture equity upside while preventing a meltdown in the event of a sudden shock. Multiply this balancing act by thousands of institutional players, and we start to see how the dual rally gains traction. Perhaps more than anything else, the extraordinary mid-2025 bull run for both gold and equities is a testament to the complexity of the present era. Investors who recall the turbulent times of past decades cannot forget how swiftly tides can turn. The fear of missing out on a prosperous rally collides with the dread of being caught empty-handed if the market takes a sharp and unforeseeable dive. The result is a landscape where opportunity and protection lose their mutual exclusivity, forging a coexistence that seems improbable until one remembers just how versatile collective investor psychology can be. After all, the same crowd that once chased dot-com euphoria later fled to the safety of gold during financial crises. Now, perhaps, they have decided to cover both bases at the same time. The scenario planning that experts conduct behind closed doors is rife with hypotheticals. What if new fiscal pressures in advanced economies create drastically higher debt burdens at a moment when markets least expect it? This would likely spur gold prices further while tightening corporate margins as interest rates edge higher. Conversely, what if breakthroughs in diplomacy or a wave of cost-saving technologies in manufacturing catapult global growth beyond even bullish projections? Then the equity euphoria could push major indexes beyond current targets, with gold perhaps shedding some of its safe haven premium, but maintaining a lofty baseline thanks to unwavering central bank support. Underpinning all of these possibilities is the fundamental question: can the ongoing tango between gold and stocks defy history and prolong itself for months or even years without a pivotal rupture? Of course, historical data suggests caution. Rarely have gold and the stock market marched in lockstep for extended periods. Typically, one eventually overshadows the other as the underlying forces become more definite. But the key difference now might be the unprecedented level of information fluidity, allowing varied investor profiles to piece together strategies that merge both risk-loving and risk-averse components. The big unknown is correlation. If we do reach a tipping point, do we see the conventional divergence reassert itself with a vengeance? Or is the new normal one where gold and equities join forces more often than not? The truth may land somewhere in the middle, contingent on how the world economy weathers the next inevitable set of storms. As we stand on the threshold of this unusual bull run, it is vital to track several signals. Central bank policy shifts, especially if inflation next year surpasses comfortable thresholds, corporate earnings and consumer spending patterns that either confirm or dispel the notion of unstoppable economic momentum, and geopolitical developments that could either stabilize global partnerships or reignite trade conflicts. Summarizing all these streams of data into a coherent outlook is no easy task. Yet, it is precisely the challenge that makes investing both exhilarating and nerve-wracking at the same time. If history is any guide, once the cracks begin to form in either sector, sentiment can shift in fleeting moments, revealing just how delicate this shared climb truly is. So, where do we land in the end? It might be both simple and elusive. As we see gold perched near its record highs and the Standard & Poor's 500 drifting only a whisper below its peak, one cannot help but sense that something has to give eventually. And yet, the synergy rests on fundamental underpinnings that are neither imaginary nor superficial. Central banks continue to accumulate gold in staggering volumes, while companies across various sectors keep releasing quarterly results that vindicate investor optimism. It is a precarious yet stunningly elegant dance, choreographed by the swirl of liquidity, cautious policy moves, and a collective determination to hold on to gains without relinquishing peace of mind. Whether it culminates in a synchrony that pushes both assets to spectacular summits or disintegrates in a swirl of volatility, this rare moment teaches us one crucial lesson. Do not underestimate the capacity of modern markets to surprise, especially when participants have learned to plan for everything and fear nothing. After all, in an era as connected and data-driven as ours, anything is possible, and the final verdict on gold and equities has yet to be delivered.